Okay, thank you everybody for coming to our webinar here on August 9th, 2017, our Fuse training, where we're going to talk about fusing together real estate and lending and really kind of give people a competitive edge, whether they're buyers, sellers, real estate brokers, doesn't matter. So the key is to understand how finance works and the basic components of finance and how it applies to real estate. So that's what we're going to dive into. You guys know the drill. If you have a question, please go ahead and get into the chat room and fire away a question there, and I'll try to answer it the best I can. Alex is monitoring the chat room as well as the overall webinar, and I'm just going to kind of rant on, so to speak. So again, great. I'm glad you guys are joining us for this because to me, it's one of the more exciting aspects of real estate. I've been doing lending and real estate for 2+ decades. I've been doing both for 2+ decades. So there's a lot of experience there, and there's a lot of, as I see the nuances of real estate and kind of how things work, I could not be more adamant that finance is the biggest component to a successful real estate transaction. Now, one of the things that I think is a fallacy and where people start with real estate is that, hey, you're a real estate agent and you're a lender. So this is my money guy, and go talk to them, get pre-qualified, and then come buy a house with me. And that's okay. I mean, that can happen, and that does happen. Some of the problems that are inherent with that is that you've got a lot of people making money on one side, you have a lot of people making money on the other side, and a lot of people, the general public doesn't know, including real estate agents, don't know where the money is being made, so to speak. And if we pare that down, if we really sharpen our pencil and figure out the best interest rate and fee structure out there for our clients, then we've got a not just a better interest rate and a lower payment, but there's also things we can do with finance to create more purchase power or to eliminate closing costs. And when you're in a competitive environment and you're in a market like Seattle where a starter home is $600,000 and the home goes on the market and there's 15 offers in 2 hours on the home, I mean, it's crazy sometimes. So there's a lot of stuff out there in the marketplace that requires we understand this a little bit better so that we can give our clients a competitive edge. And so let's dive right in. Okay, so using finance to give you a competitive edge. What that really means is saying, okay, those what I just talked about, using finance for a lower interest rate means, and lower fees mean, you can lower closing costs or eliminate them. You can have more purchase power, and so there's a lot of different things, or just have a lower payment as well. But the key is to shop interest rates. Always shop interest rates with your client. Go to a big bank, go to a credit union, go to a broker, come to K Loans, and compare fees and rates. Now, lending is not an easy process, no matter where you go. The Dodd-Frank bill and some of the issues that we've had over the past many, many years with finance has created an environment that's very, very regulated, heavily regulated. And if a T is not crossed right, an I is not dotted right, there's going to be issues. It can hold up a loan. And it gets frustrating for everybody involved because, a lot of people will say, well, I already got you a bank statement. Well, the underwriter's saying they need a new one because another month has passed or whatever day it is in the month. There's all sorts of different things that can come up, senior underwriting reviews, things like that. So one of the keys to a successful transaction is really being patient and setting expectations right as well. No matter what lender you use, understand that lending's difficult. It's a difficult process. Sometimes it seems almost like an inhuman process. Where they just don't use logic, but that's the nature of lending. It goes back into the secondary market and selling loans and making their money as well. And so there's a lot of issues involved. And they can't do that unless they follow a very strict, highly regulated guideline. Some of those guidelines are, boy, if you just take a product, if you take a Home Path product by Fannie Mae, and we go to some of our wholesale lenders and look at their guidelines, the guidelines can be 120 pages. just for that one product. And then we get into just a basic 30-year fixed or an FHA 5/1 ARM. The guidelines are really, really thick, and they change all the time. The Dodd-Frank bill, it's 8 years into it, and it's still making adjustments to lending. So counsel your clients when you're in real estate that lending can be difficult, to be patient, to get the underwriter what they need and all that. So that's just kind of a side note. And I always say that because it's, we hear about the frustrations all the time. Regardless of the lender, we still all have to kind of do it the same way. What I'm asking people to do is take your client and compare loans. And if you get a lower interest rate, you have more purchase power. It gives you that competitive edge. And let me show you how. So let's go to one of our wholesale lenders, United Wholesale, and let's take a look at their rate sheets today. Now, interest rate sheets, these vary all day long. So as we look at the rate sheets, they come and go every half hour. It's kind of like the stock market. They are constantly moving up and down. Look at it as a PDF. While it loads, yeah, we upped our bandwidth here in the office, and it seems to be even slower than it was before. So that's fun. Okay, let me get this out of the way. Let's increase this. So when you're talking about interest rates too, it can be confusing because there's a lot of guidelines, not just the guidelines, but the adjusters that we go into pricing. And what we're looking at right now is pricing. So this is how we determine what kind of interest rate you get based on your credit score, your job, your income, all these different factors at play. How much down payment you have. So a lot of people will say, hey, a 30-year fixed is 4%. Well, what are the caveats? What are the adjusters involved? So yeah, you've got a 740 credit score, you've got 20% down, you're an engineer, you've been working at a company for 10 years, you have great money, you have little debt. So yeah, you get a certain interest rate for that at the big banks. If you have that scenario with us, you're looking at a 3.5% interest rate. So here we've got our elite pricing, and you can see down here it is talking about a 740 credit score, LTVs of 80% or less, and more than $250,000 loan. So we call it vanilla. It's a real vanilla loan. It's a great loan, and you qualify for the best interest rate. Now, as we get into pricing, we look at the product here, an elite 30-year fixed up here at the top, 30-year fixed. And now you can also, I'll just a quick caveat, I do a lot of this, is if you guys have seen my webinars in the past, I kind of go off on these tangents, but hey, that's who we are. And there are adjustments. I know one of our competitors, the biggest competitor, talks about a Yorgage. They try to put a fancy name on it. Effectively, we all have that product. So you can go from an 8-year note, or a 9-year, or a 10-year, or a 14-year, or a 17-year, or a 27-year note. So you're not just limited to a 10-year, 15-year, or 30-year fixed rate. You can have a 27-year fixed rate. It's just simply amortized over 27 years instead of the usual 30. And that's what we're seeing here: 21 to 30 years, 16 to 20, 11 to 15, and 8 to 10-year loans. I heard that company on the radio yesterday talk about their interest rate for an 8-year loan was at 3.75%. Well, here I look at us today, we're at 2.75% for the same 8-year note. So that's why there's a lot there. Now let's kind of get into pricing and what pricing looks like. And again, it's important that you understand this because it does affect your real estate clients. It's not as simple as just saying, hey, you're qualified, we don't care about the interest rate, let's go make an offer. Because the offer can be predicated on this finance pricing. And so the pricing here, these numbers are a percentage. And it's at a certain interest rate, you have a certain percentage of what we call a rebate. We used to call it yield spread premium, but now we just basically call it a rebate to the borrower. In the glory days of mortgage lending, back before the collapse, the great mortgage collapse in 2008, this yield spread premium was something that mortgage brokers could make. And today, banks still can make this money, but mortgage brokers cannot. That's one of the great inequalities of the Dodd-Frank bill. So for example, here at a 4% interest rate, and again, this is a vanilla loan with great credit and 20% down, etc. At 4%, there is a rebate of 3.136% on a 30-day lock on a 30-year loan. Okay, so that's 3.136. Now, that's the same interest rate today at the big banks. If you go to the big box banks or to Quicken Loans, you're going to see about a 4% interest rate. And what they're doing is they're keeping this percentage. They get to make that money on the backside. They don't have to disclose it. And then they can sell the loan on the secondary market, make another couple points on it, or service it, whatever they're going to do. So a lot of these big box lenders typically make 5, 6 points on a loan. If you're making 5 points on a $500,000 loan, that's $25,000. That's big money. That's why Bank of America and Quicken Loans and Wells Fargo make so much money. This is where they do it typically on this residential lending, and they also do it on autos and boats and stuff like that. But lending is where the money is, and this is specifically where that money is. And so you just think, hey, they're getting a great loan, they closed, great, they've got their house, I got paid. Well, they're gonna have to go through 30 years at a 4% interest rate when they could have had a 3.5% interest rate. So that's our pricing today, and not just 3.5%, but on a 30-day lock, a rebate of 0.543. So let's do a quick calculation. We'll call it a $300,000 loan at 0.543%. That's $1,629 that this lender is going to give the buyer slash borrower towards closing costs. Again, we can't take it as a rebate or money or spiff or anything like that. It simply has to go to the borrower. And now when the borrower, if you over negotiate, and let's say you get 3% in closing costs, well, you don't necessarily need 3%. That does depend on the loan amount too. If it's a $100,000 loan, definitely you're going to need that. If it's a $700,000 loan, you don't need 3%. You're talking $21,000 for closing costs. That's just unnecessary. So you have to look at the loan amount as well as that percentage that you might be asking for. But since we're at 3.5%, a full half point better than Wells Fargo today, that's purchase power. So effectively on a $350,000 loan, if you're in this competitive market, and we saw this scenario in Kent, Washington a while back, and at a $350,000 purchase price, well, you've got everybody offering $350,000. They're all very competitive offers. Well, we can go up for the same payment of $1,722 a month. We can go up to $371,000. So $21,000 more in purchase price just because we could get a lower interest rate. Okay. So let's let you digest that one while I take a sip of tea. So on a $350,000 purchase, $21,000 more purchase power for the same payment they had already qualified for. That's what we mean by purchase power. In a competitive market, you can bump that up. And a lot of times you're limited. They're like, hey, look, we only qualify for $350,000. We went to our big bank. They said $350,000 is our cap. That's our max. Our debt to income ratio is right there. We can't go anymore. Well, guess what? This is where they can go higher, a higher purchase price and have the same payment because of a lower interest rate. So that's purchase power. Now on the flip side is closing costs. You get into these competitive offer situations and you can't really ask for closing costs because you know the competition is not asking for closing costs. So what we would do here is we would go, okay, let's go up to the big box rate of 4%. And let's get you a 3.136% in closing costs. So our same $300,000 loan, 3.136% is $9,408. Probably a lot more than we're going to need for closing costs. So I would probably dial them back into something like this, 3.875, so they get a better interest rate than the big banks and they get enough for closing costs, or maybe even 3.75. at $300,000 loan, plus at 1.889%, $5,667. That's about where we would be for closing costs. So if it were my client, I'd say, hey, let's do 3.75%. Let's get your closing costs paid for by the lender, and let's go make an offer with no closing costs attached to it. Okay, does that make sense? So we can do either more purchase power, or we can do closing costs taken care of by the lender. Okay, now that's pricing, and you can see it on here for every sort of product. Now, if they don't have a 740 FICO score and they don't have 20% down, then we can get into just regular conforming conventional 30-year fixed, and we're still at 3.5% interest rate today. The rebate's just smaller, 0.113. So negligible, really. A $300,000 loan, 0.113% is $339. You know, it might help offset half of the appraisal. But now when you hear about buy downs as well, just so you understand, a little side note, when people say, I want to buy my rate down, what they're talking about is this right here. They're saying, okay, you can do 3.5%. That's our par pricing. That's our lowest before we have to pay a price for it. If we want to buy it down to 3.375, then we're talking about a cost of 0.887. So I would say, okay, on your $300,000 loan, Mr. Buyer, you're going to owe the lender $2,661. That's going to be tacked on to your closing cost to buy down your interest rate. Now, if you can get the seller to pay 3% closing costs, and let's say your closing costs are really, I don't know, $6,500, and you've got $9,000 that they're going to credit you and give you towards closing costs, well, you can use that extra $2,500 to buy it down. So you can buy them down to a better interest rate using that closing cost. But again, in this competitive environment, it's difficult to ask for closing costs because there's another offer right around the corner coming without it. So you have to be really careful. It's this fine dance we do, a little bit of the art and science to making an offer. We go off the comps, the science part, but we also have to kind of go off our gut feeling. What are other buyers looking at? Are they interested in this house? And where do we have to come in on our offer to do that? So it also helps, if you can qualify your buyer for more money, at the same payment, but if you can qualify them for more money, then you can attach that escalation clause and go up. Again, in that scenario in Kent, $371,000, you can climb that ladder up to that price and still have that same $1,722 a month payment. So, and again, we get back to the products. There's high balance, and that's typically in high, very expensive markets like Seattle. It's in between a conventional loan at roughly $424,000 to about $515,000 before you get into jumbo territory. And then ultimately after that, you just got to do a jumbo loan. That's very market specific, by the way. Okay, so adjustments. Now, when we look at adjustments and we're pricing a loan out, you can see there's a bunch to it. This big chart are all these adjustments. If you got that 740 FICO score, Fair Isaac credit score, if you got a 740 credit score, well, there aren't a lot of adjustments all the way up to 3% down. See that 97%? That's 3% down. If your credit's not as good, if you have a 640 credit score, you missed a payment here or there, your credit's not as good, you're going to get a 3.5% adjustment to price. And then once we know what the adjustments are, we go back to price. If I have to have a 3.5% hit to price, and then I go back to, let's say, our elite high balance, I'm sorry, just our elite, I got to find 3.5% in here. And I find it all the way up here at 4.125%. So that's part of the pricing hit you take for bad credit or adjusters that, high LTVs and things like that. So back to someone advertising an interest rate saying, hey, our 30-year fixed is 4%. Well, they're not taking into account all the adjusters that are involved because there's a ton of them. So we've got credit scores, we have cash out terms, we have high balance, we have different products, home ready and home possible, 1% down FICO, greater than 680. And you see these adjustments all the way through. Sometimes you see an NA, not applicable, so it doesn't even go there. You have to limit, in this case, it's a product, or I'm sorry, investment properties. You can see these not applicable once we get to 85% LTV. So, and a 4.125 hit all the way up to 85% LTV. So that's for an investment property. So if you got some duplex someone wants to buy, they got to come in with 15% down, and they're going to take a 4+ hit on that. So we would have to go actually to our conventional pricing, take a 4% hit. There it is right there, 4.375% interest rate. Now, we can keep adjusting. We can keep climbing the ladder to include closing costs. So why don't we just start here, 4.3. We need 2 full points for closing costs. Then we would have to go to 6.2 or 6.4, and we start climbing those interest rate ladders. That's how pricing works. Let me go back to our, oh, we got 9 attendees, fantastic. No chat questions, okay, good. So everyone's kind of following me here. So yeah, the adjusters, these are conventional price adjustments. They go all the way down here. Can't do a loan less than $60,000. And all sorts of other adjustments. Now that's conventional conforming Fannie Mae, Freddie Mac products. Now we can get into LPMI and BPMI. LPMI is lender paid mortgage insurance. So understand that the lender will pay your mortgage insurance if you have less than 20% down at a cost. And typically it's about a 1/4 point or so to interest rate. Kind of use that as a barometer. So if we're at 3.5% interest rate on a 30-year fix, I would tell someone, well, you can put 5% down, but instead of paying mortgage insurance, the lender will pay the mortgage insurance, and the cost to you is going to be interest rate. So instead of 3.5, it's going to be roughly 3.75. So, and then they say something like, well, I only have 1% down interest rate. Okay, that's fine. We can do a 1% down loan. Let's see if I can find that sucker. That's down here a ways. LTVs. Oh, that's home possible. VA jumbo. Jumbo. Huh, where's our 1% down program? Doesn't seem to be listed here, but it does exist. And 1% down is, oh, here it is, home possible 1% down. So it's typically about another 1/4 point to their interest rate. So if they're at, let's say they're 3.5% par, they don't want to pay mortgage insurance, so we buy that out for a 1/4 point, and then we basically do 1% down for another 1/4 point. Well, now they're at 4%. And that's just about where the big boxes are for a conforming conventional vanilla 30-year fix. So we're talking 1% down, a $300,000 loan. They only have to come in with $3,000 and no mortgage insurance at the same interest rate the big boxes are charging. So there's a lot of muscle in finance. There's a lot of things we can do in finance. And I can't emphasize this more. Be prudent and have your clients compare loans. Have them compare what they can offer. Let's see, we have a private message going on here. Let's see it. Chat, anything. Yankees don't work. He's called twice. Oh, okay. The appraiser. Alex, will you tell him the code? Call him back and tell him the code is 2017. It's a contractor box, so it's right there next to the lockbox. So 2017. Yeah, give him a call back. I appreciate that, and just let him know I'm in a webinar. Okay. Okay, thank you. Conventional 1% down payment. There it is, right there. And look at that, 1% down. That's about right. They're at 3.625 par. So I'm telling you, this is such a good product for such a minimal nominal price. To tell someone they can, even on a $400,000 loan, they have to come in with only $4,000, and their interest rate is going to be 3.625%. That is incredible. And then if they need closing costs paid for, it's like, okay, again, a $400,000 loan, we only need about 2 points for closing costs. Well, there it is, 3.990%. So it's a really, really good deal. And again, your clients will have more purchase power if they need it, or they can have closing costs paid for. Now, conversely, when you've got a seller, and your seller is looking at multiple offers, and those multiple offers are basically, they're all over the place, but they're escalating up, and they're maybe one of them has closing costs involved, but you like it because it's 20% down, and you just think the buyer's a solid buyer, and you want to go with that. But they're asking for, let's say, 1% in closing costs. Well, there's a way to kind of alleviate that. You can say, well, we don't want to pay you 1% in closing costs, but would you be willing to look at other loan scenarios? And what we try to do is give them a good faith estimate here at K Loans. Give them a good faith estimate to give to their lender and say, will you match this? We'll do the loan at whatever interest rate. We'll pay for the closing costs. Will you simply match this? Some will, some won't. But at least you tried. At least you're showing that you're fighting for your seller so that he doesn't have to pay closing costs. A lot of times we find that. I did one just a couple weeks ago, and they eliminated the closing costs by switching over to us. And so they were pretty happy about that. They're like, wow, you're giving us a better interest rate, and you're taking care of the closing costs. So it's a no-brainer. I've also had one recently where they said, no, we want to stay with our lender, but we will have them pay closing costs. Because a lot of times if you bring this to the attention of the buyer, they go to their lender and say, hey, this knucklehead over here is telling me that the lender will pay closing costs. Can you do that? And they reluctantly go, yeah, we can do that. Here's your price to your loan. It's usually a higher interest rate, and they're okay with that. And that's fine. As long as the deal gets done, I'm okay with it. Mostly K Loans is set up to help deals get done. We make very little money on each loan. So what we're trying to do is really waken people up to the fact there's a better lender out there. There's a better interest rate. There's better fees. We'll show them these rate sheets, and that way they can go to their lender and they can kind of negotiate a little bit better deal. So that is the wholesale pricing sheet. Now you can also see there's government pricing here. You get down here and you get into conventional arms. We don't see a lot of arms. If you ever wonder about that, an adjustable rate mortgage, the pricing's not that good. I mean, I don't put anybody in an ARM because the interest rate's a little better than a 30-year fixed, but it's not a whole lot better. And so, especially with these flexible amortizations. So instead of a 5-year ARM, some people are like, you know what, we're gonna do a 22-year amortization, and that's, it'll help us get there sooner, but the rate won't change. And I think people realize right now that interest rates are so low that 5 years from now they have to be higher. They just to have a healthy market, interest rates have to go up. And so I think most people recognize getting into an ARM is just not a smart thing unless they definitively have whatever it's going to be, a 3-year contract with a school district, and then they're moving back to Cleveland or something like that. Then they're like, you know what, I'll do an ARM, I'll save a little bit of money, but I know I'm getting out of this thing in 3 years. But we just don't see a lot of adjustable rate mortgages. And then government pricing, you see if you have better credit, you're down here in a 3.25% range, actually even lower than that. We're off the charts good right now. 3.25%, we're almost paying for closing costs right there on a 30-year fixed. So that's an FHA loan. There's also VA fixed. VA is similar, 3.25, but the rebate is not quite as good. And then VA Jumbo, we're still down at 3.25%, but now the rebate is just a little less than half a point. So VA and FHA loans are fantastic if you don't qualify for a conventional loan. VA is actually a really good loan. FHA is not so good. The problem with FHA, just as a side note, is there's mortgage insurance for the life of the loan. We're hoping that changes back to the way it used to be when you had 20% equity in a house, the mortgage insurance would drop off. But again, under the Dodd-Frank bill, they decided, well, let's just have mortgage insurance be there for all 30 years of this government loan. So that's the real downside to FHA. But otherwise, the qualifying numbers are easier. We've got FHA products that will go down to 500 credit scores with 10% down. So it's a flexible, more higher DTI, up to 55% DTI if you have decent credit, if you have a 620, 640 credit score. So a lot of that flexibility is in those government loans. And then government arms, again, I went off on arms. Jumbo products, if you get into the $600,000, $800,000 range, just talking about a higher interest rate, but not that much higher. Look at that, 3.75% is the Jumbo Elite program with a half point back. So pretty good. We're talking 740 credit scores. So you do have to have a good credit score to qualify for that. If you don't have a good score, we're at 3.875 with a 0.232% rebate to the buyer for a jumbo loan, $600,000, $700,000, $800,000. And then some jumbo loan adjusters. But pricing, the thing about loan pricing is it's very fluid. It changes all the time. It's really hard to compare apples to apples in the industry. So the key is to have your clients compare quickly. So they don't want to wait 2 weeks. Number one, they can have their credit pulled multiple times in a 2-week span, and it only counts as one hard pull against their credit. So the idea being that with consumer protections, they want them to be able to find the best interest rate in that small period. And so the key is to go out 1, 2, 3 different quotes within a 2 or 3 day period. And that way they've got a pretty good idea of what the comparable interest rates are going to be. Okay. Let's go back to here. So we've talked about eliminating closing costs for the buyer and the seller. We've talked about more purchase power. Obviously, a better interest rate means lower payments. If someone's just like, you know what, I'm buying this $300,000 house, I want the lowest payment possible for 30 years. And let's say they only save 30 bucks. Well, 30 bucks times 12 months a year times 30 years is $10,800 they save by having a little bit lower interest rate. So, and typically on these higher loans, 1/8 of a point or 1/4 point, or especially a 1/2 point, amounts to hundreds of dollars a month. And then you amortize that over 30 years, and you're talking $100,000 that they can save. So there's a lot of power, a lot of muscle in finance. That's the reason, again, the reason Quicken Loans and Bank of America and Wells Fargo are so big is because there's so much power and money in these loans. And if you don't use it to your advantage, well, you and your client could lose. Okay, so how to specifically use this to sell yourself and win business. Okay, here's the big one. Really, it's really a pretty simple process, and I don't want to make it complicated, and it shouldn't be complicated. It's basically you are an advisor. You're an advisor to your client in real estate, and all things real estate, which starts with lending. So you start in that pre-qualification process, but you want to make sure you give them the good advice of comparing lenders. So you compare 3 different lenders, find the best interest rate, find the best fee structure, and find the best terms for their loan. In that way, you're giving them good advice, and you're looking out for them financially. You're meeting your fiscal responsibility and fiduciary responsibility to your client. And that's really how you want to sell yourself, is that, hey, I know of lenders that will eliminate closing costs so that we don't have to ask a seller to pay for closing costs, which makes your offer stronger. Oh, really? Who are they? Okay, it's K-Loans. Now compare K-Loans. We never want to say they're the best and just go with them. That blind trust, I think, is foolish. You want them to compare. So say, hey, who do you bank with? Oh, Umpqua? Well, get a quote from Umpqua. Get a quote from K-Loans, and go get a quote from a credit union. and see who's got the best interest rate and fee structure, then proceed from there. And once you do that, we'll guide them on the closing cost portion of it. We'll guide them on, how to use that rebate to pay for closing costs or how to increase their purchase power. So you as a real estate professional just have to say, hey, I can guide you into certain products that other real estate agents cannot, because we have this specific fused training and we have not just an in-house lender, but our company owns the lender. We are the lender. So Kelly Wright International owns K Loans as well as Kelly Wright Real Estate. And by doing that, you're really giving them a heads up and an advantage. And when they go to purchase, when they're going to sell a home or list a home, say, hey, we know that the lender will pay for closing costs, so I can help guide you when those offers come in and there's closing costs attached to them. We can help guide that buyer out of paying you or having you pay the closing costs and make sure that the lender pays the closing costs. Because most of the time they're tapped out. They only have so much money. They've saved and saved and saved for their down payment. They don't have an extra $5,000 or $6,000 for closing costs. So I get it that the closing costs aren't always there. It's not easy to just write a check for that, but the seller does not always have to pay it. And a lot of times they don't realize that. A lot of times they've gone through life always having the seller pay the closing costs. They just think that's par for the course. Well, it doesn't have to be. And then you can also qualify more buyers. So, hey, Mr. Seller, at a lower interest rate, because K-Loans can qualify more buyers at a lower interest rate, that means we can get more buyers qualified for your house. So you've got an extra pool of 10%. If you're listing your house at $300,000, there's a bunch of people that are limited to 270 or 280. Well, now we can bump them up. We can help bump them up into that 300 mark, because they're going to come in saying, hey, woe is me, I can only afford 280. My lender said that's it. I've maxed out on my debt to income, and they're at 4% interest rate. We would take a look at that file and go, hey, wait a second, at 3.5% interest rate, you can now get up to $300,000. That's a $20,000 difference for your client when he's selling a house. And that's effectively what we can do better than other real estate companies. And that's what we teach here in our Fuse training. And we're creating right now new flyers and new inserts to really and powerfully and simply explain what we do. Okay, any questions on that? Let's see. Nope, nope, nope. Okay, got that. Okay, now professionalism. I want to talk about this real briefly, and again, I appreciate everyone joining us. I love talking about this stuff, but we're trying to make these webinars a little more fine-tuned and less lengthy, less wordy. So we're trying to just get to the meat of the topic, and then it makes it easier for us to stream it and send it to people. But the last thing I want to talk about is professionalism. We are real estate professionals, and I'm going to harp on that for the rest of the year because we are seeing a very dynamic and competitive real estate market. And I find that sometimes the real estate agents get caught up in the emotion of the moment. Their client is really just ticked off about something. It could be an inspection. It could be seller didn't do something that they said they were going to do. Somehow the funding or the finance is getting delayed, and their client's going berserk, and they've got a moving van pulling up, and they can't do an extension, and someone else is digging in. And real estate agents will they'll take that emotion, internalize it, and they'll get emotional. Don't do that. Be the calm one. Be the professional that's like, look, it'll be okay. We just have to get through this period, whether it's an extension or whether it is a condition that wasn't met, we just have to help negotiate it, talk to the other party, and get a resolution, get something solved for them. I find more deals break down when real estate agents start getting emotional. And I think most of you have probably seen this. You get real estate agents that are just furious. And it's like being furious doesn't help solve the problem. In fact, it hurts it. So being professional in this competitive environment is really key. Obviously, be very attentive to your clients, do things very quickly, communicate well in a quick, concise manner, make sure that you're meeting all your deadlines and dates. and your paperwork is complete. So if you do all those things, fantastic. But just again, don't internalize this emotion and become part of the problem. Be the solution and act very calm and professional. I've seen 12,000 deals over the course of my career as a designated broker and an agent, and I've seen a lot of major problems, and that's kind of my specialty right now is really solving these problems and issues. But I usually see the problems occur when unreasonable people have an unreasonable amount of emotion involved. And if they could step back and go, you know what, it's not the end of the world, but we do have to solve a problem, and they do it in a mature, level-headed way, then the problem usually gets solved. So just remember that when you go out there. I'm saying that just because it's August 2017. There's a lot of deals going on, and I'm seeing a lot of emotion. It's not just the sun that's hot. I'm seeing a lot of agents and their clients get pretty hot right now. So that is it. Let's go back and check and see if there are any more questions in the chat room. There are not. Do you guys have any questions about any other topics or anything you're seeing in the marketplace? Nope. Okay, good. Well, we came in under an hour, so I met my goal. I'm pleased with that. We're going to go ahead and record this, and we're going to get it up on YouTube, and then Alex will email it out to everybody. But it's a good lesson in how to use finance to benefit your client and also to generate more business. So we're going to continue to play off that, and we're going to continue to promote that and try to make it as simple and concise as possible. It's a complex issue. It's a complex way of looking at generating business, but it is real. We see it all the time, and I want to make sure people understand that finance is where real estate starts. Okay.
Hey, Joe.
Yes.
Joe, real quick, we have a question. Can you discuss the fine process with the MLS, it looks like?
I can, Michael. I'll send you an email on that one. We want to keep it off of this, but just in brief, MLSs, if you make a mistake, they can be brutal. They can be harsh. They will fine you. So the key to that is make sure you follow up and take care of whatever they're asking you to take care of. We are not responsible for your mistakes. And so the MLSs, they all operate a little bit differently, but they all will fine you. And we see fines going out to everybody on every different MLS. And so especially the automated systems like the Northwest MLS, they will do little fines. And then if you do something egregious or something that they find to be a little bit bigger, they'll ding you. Anyway, that's it. I appreciate that, Michael, but I'll send you a note off.
Perfect.
Now, so Fuse training for August 9th, 2017 will conclude, and I appreciate everybody watching, and we'll have this thing up on YouTube by the end of today. Thank you very much, everybody.